Maybe we should stop beating ourselves up quite so much about creating non-recourse, complex securitization sort of structures. And maybe these pension funds and insurance companies should just be investing in highly rated paper from well-known utility companies, because interest rates are so low right now anyway. And perhaps that would actually just allow more of the money to flow directly that way.
Yeah, no, the big problem, I suppose, with utility companies is that the model, the regulatory model that is used throughout the world, by definition, specifically with the introduction of renewables, can't work anymore. People get paid, get guaranteed almost a rate on return on the investment that they have made in coal or gas-fired power plants. And specifically what we see now in Europe, if you get more renewables, there's suddenly a new competitor in the open market out there. The return that was guaranteed is basically, it's a price on the electricity that is sold, which is an estimate based on the demand that they think they'll be able to supply to in the next couple of years. If that demand is lower, the reaction is to increase prices. If prices increase, there's more demand for renewables, because specifically in areas like Germany and France as well, more and more you have renewables are on a retail basis are cost competitive. So there's a lot of debate about the model and whether or not utilities should be paid for just having capacity, because their power plants are more and more there for peak and not base load, and they just have to build a gas-fired power plant just in case. So we basically almost have to double our capacity. If you have solar, you have to build the same capacity in gas, just in case there's not enough sun or light, or in the case of wind, there's not enough wind. And that's a model that is quite difficult to explain, I suppose, and can work short term, but if one day we'll have a solution on storage, is not even a long-term solution. So I would doubt that investing in what currently is seen as high quality utility paper will be high quality, or will continue to be high quality in the future, to be honest.
I think what you're saying makes sense, in especially, and I'll speak in the U.S. context. As you may know, in the U.S., a lot of the subsidies for renewable energy come in form of tax credits. In fact, that's the primary subsidy in the United States. Is there's basically an investment tax credit or a production tax credit that comes. And so you really have two types of scenarios. You got these very structured deals, and we play in that. You've got people who come in just to monetize the tax benefits. These are, very complex, very structured deals. And then you have the other extreme, which is kind of like I alluded to, Berkshire Hathaway through Mid-American. They go and buy these, and they can enjoy all the tax benefits. They can raise, debt at, they're obviously, very much blue chip investment grade entities. And we do find more and more utilities, primarily sometimes through the unregulated arms, really, buying a lot of these projects, and they're the most competitive because they don't have to worry about this additional structuring and bringing in tax equity investors and making these things very complicated. I mean, we like complicated because that's our business. But if you really look at it, there's a reason why they've emerged as very large investors and players in this, because it's, frankly, it's simpler in many respects.
I think that market will continue and people investing in bonds and utilities, but it brings with it a carbon risk. So we talked about balancing portfolios. If you invest directly in the renewable assets, you avoid that carbon risk. And those assets are pretty attractive in the sense that they're long dated, they're cash yielding, they're 20 years plus. Certainly in the UK, we've got indexation to inflation. They're exactly the type of cash yielding assets that neatly offset pension liabilities. So why not invest in them directly, get all of the benefits, match your obligations, and avoid the carbon risk that you have embedded in that in investing through the utility structure?
As a bank, when there's a demand, we will try to match it. I mean, and those companies, pension funds and insurance, they're going to invest in the utility papers anyway. But there's a demand right now to either offset the carbon risk, or there's also interested in the yield that those companies are getting right now. So there's a demand, so we work on it. We haven't found proper solutions yet, but we still keep working on it.